CLS Market Review for the month of March 2014. I'm host Matt Harwell. It was a rocky month for the stock market, with the broad U.S. market ending the month near unchanged levels. Nonetheless, the S&P 500 remains near its all-time highs. Domestic small caps did lose ground in March, as did international securities. The bond market was basically unchanged. The 10-year Treasury yield finished the month near the midpoint of its multi-month range at 2.75%. Given the choppy start to the stock market this year, how has our outlook changed? For this, we go now to our Chief Investment Officer, Rusty Vanneman. Rusty.
Thanks, Matt. So in short, our outlook for the financial markets, both for stocks and for bonds, remains positive. That said, our return expectations are muted. Our caution stems from a handful of concerns. First, the overall U.S. stock market is overvalued, especially for smaller companies. Second, investor sentiment remains too complacent and favorably inclined towards stocks and away from higher quality bonds. Third, the extremely positive liquidity backdrop for both stocks and bonds may go away in the not too distant future. Economic data has been weak early this year. According to ITR Economics economist Brian Bolio, who is also a member of the CLS Investment Committee, he believes that the blame the weather card that most commentators have been mentioning has been way overplayed. He also expects more economic weakness in the months and quarters ahead. It appears that the economic softness is legit. Finally, we're in a mature bull market. We've had strong gains over the last 5 years. In fact, according to analysis by CLS analyst Sierra Morris, whenever the market has had such a strong return as it has over the last 5 years, returns over the next 1, 3, 5, and 10-year time frames tend to be below average, though still positive. Despite these factors, we don't believe that investors should abandon the stock market expecting a correction. Given the historical probabilities for positive returns in all time frames, including the 1-year time frame, it's generally a losing bet to get significantly bearish. While I'm uncomfortable comparing investing to betting, as fiduciaries don't bet, a radical restructuring of a portfolio expecting a correction is a bit like betting on a low-seeded team to win the NCAA tournament. Sure, it's possible, but it's not probable. Wow, that's pretty bad. The best course for long-term investors is to stay balanced and to stay diversified. While stocks are essentially flat to slightly lower this year, the bond market has gained about 2%. Commodities are up nearly 7% year to date. International markets continue to lag, but there have been some international markets outperforming the U.S., particularly in recent weeks, including the emerging markets. When it comes to balanced portfolios, remember it's not just about total returns. It's also about controlling and managing risk. Balanced portfolios tend to have lower risk than the overall stock market. Balanced portfolios tend to have steadier risk levels. Balanced portfolios essentially offer smoother rides, so to speak, so they're easier for investors to stay the course. Add it all up, and it's like the great quote from another CLS Investment Committee member, Craig Israelson, who said, "In truth, building a broadly diversified portfolio is really the only logical investment philosophy, both mathematically and emotionally." Thank you, and stay balanced. Matt?
Thank you, Rusty. For our complete monthly market review, I invite you to download this month's PDF on clsinvest.com or subscribe to our podcast on iTunes. Also, look for our quarterly market review Thursday, April 17th here on clsinvest.com. That concludes our update for this, the third month of 2014, and we hope to see you back next Tuesday. Thank you very much for your time and trust in CLS Investments.